in a dramatic shift that has helped define the economic landscape of 2025. Leading central banks around the world pursued an aggressive cycle of monetary policy easing, the most extensive since the global financial crisis of 2008. Over the year, major institutions, including the U.S. Federal Reserve, the European Central Bank, ECB, and the Bank of England, collectively cut interest rates around 32 times, totaling roughly 850 basis points in reductions. This historic easing reflected persistent fears of slowing growth as inflation pressures eased and policymakers sought to support demand across both developed and emerging economies. For many developing markets, central bank rate cuts were especially deep and frequent, helping lower borrowing costs and tempering risks of deflation. Nations such as Turkey, India, and Mexico were among those that implemented substantial cuts, contributing to a combined emerging market easing total that exceeded previous years' efforts. The context for this policy pivot was a complex mix of slowing global activity, lower commodity prices, and, in some cases, financial market volatility. By cutting rates, central banks aim to safeguard fragile economic momentum, stave off recessionary pressures, and support investment and consumer spending. However, analysts caution that what may seem supportive in the near term could limit future options should inflation spike unexpectedly, with policymakers signaling the possibility of tightening again in 2026. The global monetary outlook remains unsettled. For investors and businesses alike, this trend underscores a year shaped by policy intervention and an acute focus on preventing prolonged economic stagnation. The ripple effects of this easing on exchange rates, asset prices, and credit conditions will extend into 2026, shaping strategic decisions around the world.